You're listening to this article from Convertz.app. What is Bitcoin halving and why does it matter? The basics of Bitcoin supply. Bitcoin was designed with a hard cap. There will only ever be 21 million Bitcoin. This is written into the protocol's code and cannot be changed without the consensus of virtually the entire network. New Bitcoin enters circulation through mining. Miners use powerful computers to process transactions and secure the network. In return, they receive newly created Bitcoin as a reward, the block reward. This is the only way new Bitcoin is created. As of early 2026, approximately 19.8 million Bitcoin have been mined, leaving roughly 1.2 million still to be created over the next century plus. What happens during a halving? Every 210,000 blocks, approximately every 4 years, the block reward is automatically cut in half. This event is called the halving or halvening. Here is the complete history. Event, date, block reward, total Bitcoin mined. Genesis, January 2009, 50 Bitcoin, 0. First halving, November 2012, 25 Bitcoin, approximately 10.5 million. Second halving, July 2016, 12.5 Bitcoin, approximately 15.75 million. Third halving, May 2020, 6.25 Bitcoin, approximately 18.375 million. Fourth halving, April 2024, 3.125 Bitcoin, approximately 19.6 million. Fifth halving, approximately 2028, 1.5625 Bitcoin, approximately 20.3 million. Notice how each halving produces fewer new coins. The first 10.5 million Bitcoin were mined in just the first 4 years. Now, in 2026, only about 450 Bitcoin are mined per day, compared to 7,200 per day in Bitcoin's early years. The economics, supply and demand. The supply shock. The halving creates what economists call a supply shock. Before the 2024 halving, miners were producing roughly 900 Bitcoin per day. After the halving, that dropped to approximately 450 Bitcoin per day. In dollar terms, at, say, $80,000 per Bitcoin, the daily new supply dropped from about $72 million to $36 million. That means $36 million less in daily selling pressure for miners who need to sell Bitcoin to cover their electricity and equipment costs. Why this matters? If demand stays constant or increases, while new supply is cut in half, basic economics predicts the price should rise. This is the fundamental investment thesis behind Bitcoin's halving cycles. The stock-to-flow model. One popular framework for understanding halving is the stock-to-flow (S2F) model, which compares the existing supply, stock, to the new annual production, flow. After each halving, Bitcoin's stock-to-flow ratio doubles, making it comparatively scarcer than gold. While the S2F model has been directionally accurate over long time horizons, it has significant limitations and should not be relied upon as a price prediction tool. You can track Bitcoin's current price on Convertz.app's Bitcoin converter to see how the post-halving market evolves. Historical price action around halvings. First halving, November 2012. Price at halving, approximately $12. Price 1 year later, approximately $1,000. Price at cycle peak, November 2013, approximately $1,150. Bitcoin went from a niche experiment to mainstream media coverage for the first time. The approximately 100x price increase from halving to peak was extraordinary. Second halving, July 2016. Price at halving, approximately $650. Price 1 year later, approximately $2,500. Price at cycle peak, December 2017, approximately $19,700. The 2017 bull run was driven by ICO mania and retail fear of missing out. Bitcoin became a household name, and crypto exchanges were overwhelmed by new signups. Third halving, May 2020. Price at halving, approximately $8,500. Price 1 year later, approximately $57,000. Price at cycle peak, November 2021, approximately $69,000. This cycle was unique because institutional adoption, Tesla, MicroStrategy, and eventually Bitcoin ETFs drove demand alongside the supply reduction. Fourth halving, April 2024. Price at halving, approximately $64,000. Price trajectory. Bitcoin reached new all-time highs in 2024 to 2025, buoyed by spot Bitcoin ETF inflows and continued institutional adoption. The pattern so far has been consistent. Each halving is followed by a significant bull run, though the magnitude of returns has diminished with each cycle, which is expected as Bitcoin's market cap grows. The diminishing returns pattern. An important observation. While each halving has been followed by price increases, the percentage gains have decreased with each cycle. First cycle, approximately 100x gain from halving to peak. Second cycle, approximately 30x gain. Third cycle, approximately 8x gain. Fourth cycle, TBD, but likely lower multiples than previous. This makes sense. It takes far more capital to double a $1 trillion asset than a $1 billion asset. As Bitcoin matures and its market capitalization grows, the explosive percentage gains of early cycles are unlikely to repeat. Impact on miners. The immediate squeeze. When the block reward is halved, miners' Bitcoin revenue is instantly cut by 50%. This is a severe shock, especially for miners with high electricity costs or older, less efficient equipment. The shakeout. After each halving, the least efficient miners are forced to shut down. This temporarily reduces the network's hash rate, total computational power. The difficulty adjustment mechanism then lowers the mining difficulty, making it slightly easier for remaining miners to find blocks. The recovery. If Bitcoin's price increases sufficiently post-halving, mining becomes profitable again for a wider range of operators. New, more efficient mining hardware is developed, and the hash rate typically recovers and exceeds pre-halving levels within 6 to 12 months. The trend, mining industry maturation. Each halving accelerates the mining industry's professionalization. Hobby miners and small operations are replaced by publicly traded mining companies with access to cheap renewable energy and institutional capital. This trend is clearly visible by 2026, with companies like Marathon Digital, CleanSpark, and Riot Platforms dominating the industry. What happens when all Bitcoin are mined? Around the year 2140, the final fraction of a Bitcoin will be mined. After that, miners will earn only transaction fees, no block rewards. This raises a key question. Will transaction fees alone be sufficient to incentivize miners to secure the network? Optimists argue that as Bitcoin becomes more widely used and valuable, transaction fees will be substantial enough. The development of the Lightning Network and other Layer 2 solutions may also create additional fee opportunities. Pessimists worry about a potential decline in network security. This debate is ongoing, but it is important to note that we are over a century away from this scenario. The bottom line. Bitcoin's halving is one of the most elegant features of its design. It creates a predictable, decreasing supply schedule that cannot be manipulated by any government, central bank, or corporation. This programmatic scarcity is the foundation of Bitcoin's value proposition as digital gold. Whether or not the halving will continue to be the dominant driver of Bitcoin price cycles is debated. As the market matures, institutional flows, macroeconomic conditions, and regulatory developments may become equally or more important than supply dynamics. What is certain is that each halving makes Bitcoin scarcer. And in a world where most currencies are being created in ever larger quantities, that scarcity is what continues to attract believers. Disclaimer. This article is for educational and informational purposes only. It does not constitute financial or investment advice. Bitcoin and cryptocurrency investments are volatile and carry significant risk. Historical price performance does not guarantee future results. Always do your own research and never invest more than you can afford to lose. That's the end of this article. Visit Convertz.app for more guides and free conversion tools.